As Congress debates the budget and the government remains shut down, a major deadline looms: the expiration of the Enhanced Affordable Care Act subsidies. Without this support, people may begin to see soaring premiums, increased medical debt, and higher rates of poverty. The Affordable Care Act's enhanced premium subsidies, the extra help that makes health insurance affordable, are set to expire. In 2025, roughly 24 million people got coverage through the marketplace, and 93% relied on some form of subsidy. If Congress lets these enhanced subsidies lapse, nearly 5 million Americans could lose coverage, a turning point for our health system and for families who fear being uninsured. You might ask, what did these enhanced subsidies actually do? Well, they open the door for millions to get coverage, slashing out-of-pocket costs and helping middle-income Americans afford insurance. This is government capacity at work, a public investment that made private markets function for everyone. Marketplace enrollment more than doubled after these subsidies took effect, reaching record highs, and now all of those gains are at risk. Without these subsidies, premiums are poised to soar. Insurers have already filed double-digit rate hikes for 2026. Some of the steepest increases are projected in the South and among rural states. On average, premiums could jump 75% next year. For example, a 60-year-old couple earning $85,000 a year could see their bill rise to over $22,000, a quarter of their income. For many Americans, coverage will simply slip out of reach. And when premiums surge, families face an impossible choice: pay for insurance or pay for rent and groceries. Healthier and lower income people are the first to let coverage go, and middle income families just above the cutoff are next. Suddenly, they face the full sticker price of a plan they can't afford. Millions could once again join the ranks of the uninsured. And this is how the market unravels. When healthy people drop coverage, those left behind are older and sicker. Insurers raise premiums to cover the higher costs, which drive even more healthy people away. It's a dangerous feedback loop, a spiral that health economists call adverse selection. And businesses are already warning that it's on its way. Insurers will be under pressure to act, not for the benefit of their enrollees, but for their bottom lines. With a sicker pool and reduced federal support, they'll raise premiums, cut plan options, and in some markets, pull out of business entirely. For consumers, that means fewer choices and higher costs. Now, how does that happen? Well, when insurers withdraw, competition evaporates. Some regions could be left with just one marketplace option, or none at all. History shows that in regions with just one insurer, people pay more than $100 or more per month on average. As competition fades, prices climb for everyone. Not everyone will drop coverage overnight. Many will simply downgrade. They'll trade a solid silver plan for cheaper bronze ones with massive deductibles. They'll technically have insurance, but not real protection. Already, 1 in 4 insured adults are underinsured. As premiums rise, more families will fall into debt or poverty after a single illness or accident because their insurance is inadequate. The effects ripple through the whole system. When people lose insurance, they still get sick, and they show up at hospitals unable to pay. This leads to uncompensated care that could climb to more than $7 billion next year. With that, providers lose more than $32 billion in revenue. Then, rural and safety net hospitals already operating on the edge will be hit the hardest. Closures and service cuts could leave entire communities without care. This moment is bigger than one policy deadline. It's about the kind of country we choose to be. Ending these subsidies would reverse years of progress and signal another retreat from the common good. And this isn't the end of the story. Next year, Medicaid work requirements could drop another 4.8 million people from coverage, amplifying these effects. The ripple effects of one decision today could weaken the entire system tomorrow. When we pull one thread from the fabric of the healthcare system, things begin to fray. This is the ripple effect of losing the enhanced ACA subsidies, a crisis that is still preventable.